The year 2025 began with a sense of cautious optimism for the stock market. However, this fragile optimism was shattered in early March. The catalyst? A series of sweeping trade tariffs imposed by the government. These tariffs targeted goods from major trading partners. The stock market reacted swiftly and dramatically. Major indices like the Dow Jones and S&P 500 experienced their sharpest declines in years. The suddenness of the drop left investors reeling and searching for answers. The tariffs, coupled with retaliatory measures from trading partners, fueled anxieties about a global trade war. Memories of the 2018 to 2019 trade war, which saw tit-for-tat tariffs between the US and China, loomed large. Investors feared a repeat of the economic uncertainty and market volatility that characterized that period. The specter of the Smoot-Hawley Tariff Act of 1930, often cited as exacerbating the Great Depression, added to the sense of unease. The stock market, a barometer of investor confidence, reflected this growing fear. The market plunge, while triggered by the tariff announcement, was not entirely unexpected. Warning signs had been flashing in the weeks leading up to the event. Economic data released in late February painted a worrisome picture. Consumer sentiment, a key indicator of economic health, had plummeted to its lowest point in over a year. Fears of inflation, fueled in part by the impending tariffs, weighed heavily on consumer confidence. The housing market, a crucial pillar of the economy, also showed signs of strain. Existing home sales fell significantly below expectations. Rising interest rates and stubbornly high property prices made homeownership increasingly unattainable for many. This slowdown in the housing market further dampened economic sentiment. The services sector, a major engine of economic growth, also sputtered. The services PMI, a closely watched index, contracted for the first time in over 2 years. This contraction signaled a slowdown in business activity and raised concerns about the overall health of the economy. The impact of the trade tariffs and subsequent market plunge reverberated across various sectors of the economy. The automotive industry, heavily reliant on global supply chains and cross-border trade, was hit particularly hard. Shares of major automakers like Ford and General Motors tumbled as investors anticipated higher costs and disrupted production. The retail sector also felt the heat. Companies like Best Buy and Target, dependent on imported goods, faced the prospect of rising prices and squeezed profit margins. Their stock prices reflected these concerns. The technology sector, a darling of the stock market in recent years, was not immune to the downturn. The Nasdaq, heavily weighted towards technology companies, experienced a significant decline. Giants like Apple, Microsoft, and Amazon all saw their share prices fall. The semiconductor industry, already grappling with supply chain disruptions, faced further uncertainty due to the tariffs. Companies like Nvidia, a leading chipmaker, were particularly vulnerable. Section 4, Expert Opinions, a symphony of uncertainty and opportunity. The market turmoil and economic uncertainty left experts divided in their assessments. Some analysts warned of a prolonged period of volatility and a potential recession. They pointed to the escalating trade war, rising inflation, and slowing economic growth as red flags. Others, however, urged caution and perspective. They emphasized the resilience of the economy and the potential for the market to rebound. They argued that the current downturn presented buying opportunities for long-term investors. Market strategists generally agreed that the trade tariffs would likely lead to higher consumer prices. They also predicted that corporate profits would be squeezed, as companies faced higher input costs and reduced demand. Despite the prevailing uncertainty, some analysts identified pockets of opportunity. For example, Morgan Stanley upgraded Chipotle, citing the company's strong fundamentals and ability to weather economic storms. Similarly, Wedbush remained bullish on Palantir, a data analytics firm, calling it a top name for 2025. Section 5. Navigating the downturn strategies for the prudent investor. The market plunge, while unsettling, served as a stark reminder of the inherent volatility of financial markets. It underscored the importance of a well-defined investment strategy, particularly during times of uncertainty. Diversification, a cornerstone of prudent investing, took center stage. Experts advised investors to ensure their portfolios were spread across different asset classes, including stocks, bonds, real estate, and commodities. Safe haven assets, such as gold and government bonds, traditionally considered less risky, gained renewed appeal. Investors flocked to these assets as a way to preserve capital during the market turmoil. However, experts cautioned against making drastic changes to long-term investment plans based on short-term market fluctuations. They emphasized the importance of staying the course and maintaining a long-term perspective. The market downturn, while undoubtedly challenging, presented an opportunity for investors to reassess their portfolios, revisit their investment strategies, and reaffirm their financial goals. By focusing on the fundamentals, maintaining a long-term perspective, and seeking professional advice, investors could navigate the downturn and emerge stronger on the other side.